Good morning, traders and investors. Roger Scott, Senior Strategist for Wealth Press. Today's Tuesday. It's March 21st. It's about 7:43 in the morning. The market's going to gear up to open up in about an hour and 45 minutes, give or take. My math isn't all that great this morning. Now, again, we're already in the third week of March, and it appears to me that the markets are starting to stabilize following this banking debacle that occurred last week. Now, I want to bring your attention to something really important, and there's a lesson here. Before we get into the deep analysis, there's a lesson here, and this lesson is actually very timely. Now, tomorrow we're going to have the FOMC, and there's about 75, 80 something percent. We'll get into all the details in a few minutes that the Fed is going to raise rates 1/4 of a basis point. Now, remember, the bond market, listen carefully, there's something in it for you. The bond market has an inverse relationship with interest rates. So notice how the bond market is starting to give up the ghost, that this high is giving up. It looks like it's going to go down. This is going to be impactful, and the bond market is going to go down if the Fed, in fact, does raise rates 1/4 of a basis point. But what happens, and what is the relationship between the utility sector, which is right here, and the bond market? Well, let me explain. Notice they kind of look alike. Well, here's the thing you need to understand. And again, a lot of people let me connect the dots for you, okay? It's important. Why do people buy utilities? Most people buy utilities for the dividend yield, okay? When bond yield is getting higher, folks tend to take money out of utilities and put their money in the bond market. When bond yield gets weaker, when bonds go higher, means they get weaker, folks put their money in utilities to get more interest rate, to get more dividend yield. I'm trying to say three different things, so I'm trying to be as concise as possible. So again, when bonds go up, interest rates go down. When bonds go down, interest rates go up. It appears to me that bonds are ready to go down a little bit again. Let me go back to the bond market, which means interest rates will probably go up 0.25 tomorrow. So if interest rates go higher tomorrow, utilities will go lower tomorrow, right? If bonds go lower tomorrow, utilities will go lower tomorrow because interest rates will go higher tomorrow, okay? So there's a very strong correlation between bonds right now, as you could see this, and utilities, because if bonds go down, interest rates go up. If interest rates go up, that's a challenge to the utilities because folks are saying, hey, is the yield higher on utilities? Because why do people buy utilities? For the interest yield. They have good yield. They have the highest yield of most stocks. So people buy utilities because of the yield. One more thing. If interest rates go higher, the cost of utilities go higher because you have to borrow more money for those utilities. They borrow money, right? So utilities go down for two reasons. They go down because bonds take the yield, the competitive yield, interest yield away from them, and because yield is heavier, which means it's harder for them to get things done. So my point is, if the bond market goes down tomorrow, I wanted to give you this lesson because a lot of folks don't realize this. If the bond market really tanks tomorrow, there's a good chance utilities will go down as well. And we are short utilities in one of our programs due to seasonality, but that was also a factor, and I wanted you guys to know that. Hopefully that was a good lesson that you just learned. So remember, utilities go up or down based on interest rates. If interest rates go higher, that's bad for utilities. And for two reasons, because they have to compete with yield from the treasury bonds and because there's borrowing cost. So if tomorrow the Fed raises rates, that's going to be bad for utilities. Now, why did the bond market rally and why did interest rates go lower in the last couple of weeks? Because of the banking debacle. But the banking debacle is behind us, from what I understand. And if that's the case, then interest rates are going to go higher and bonds are going to go lower, and that's going to put pressure on utilities. So you may want to stay short utilities for the time being, at least throughout tomorrow, because there's a good chance if you're short utilities, you should stay short utilities. There's a good chance utilities will go down based on the interest rate hike. So I wanted to explain that to you guys and make the connection between utilities and the bond market and yield so you understand exactly how they work. And that's one of the reasons why there's such a high correlation between bonds and utilities, especially right now. So on the horizon today, we have existing home sales. Now, this will be really interesting because permits last week and housing starts were unusually strong. And I mean really unusually strong. So there's a great chance that this number may be good. And if it is good, It's expected to be at over 4 million. If it is over 4 million, I mean, look at this year over year, 36% downside. Ouch, existing home sales. But if this number's good, it may give us signs that the housing market is starting to recover, which is a very, very, very positive sign. Now, let's talk a little bit about the market as it stands right now. The market's gearing up to open up pretty good today. Definitely not random. 100 points or 90 points on the Nasdaq, 265 points. Just so you know, with this volatility, anything below 100 up or down is random on the Dow, in my opinion. It used to be about 60 to 80. Now it's about 100 because of the volatility. But we're 261 points in. So this is this is a good, strong sign. And also the fact that tech is up is telling us that the tech is brushing off the bond market this morning, which is actually down 66 ticks, which increases yield. So that's a good sign. That's a strong sign for Nasdaq. I was concerned how Nasdaq is going to take that into account, especially in light with the fact that we kind of broke down yesterday, and it looks like we hit a high, and it looks like we're starting to come down, which would also be or make sense if the interest rates went up 1/4 basis point. Now let's talk a little bit about the global economy. We can kind of tie in all these things that I'm talking about together. So 3 major U.S. benchmark indices ended the regular session higher as the historic rescue deal for Credit Suisse helped strengthen sentiment on the banking stocks while investors' attention shifted to the Fed. Now, I'm hoping there's no more banking drama and we can now move past this. At the same time, the Nasdaq underperformed because interest rates went higher as a rebound in U.S. Treasury yield, interest rates, and over 14% slide in PDD limited gains in the tech-heavy net index. And we're also at our resistance level to the upside right here. And we're also diverging, as you could see right here. Lower high, higher high, right there. So several reasons, technically and fundamentally speaking. Federal Reserve kicks off its 2-day meeting later today. Market may be subdued till the decision tomorrow. Consensus firming in recent days around the expectations of a 25-point hike on Wednesday. Meanwhile, U.S. futures have priced in an 83.4% chance of a 0.25 basis point rate hike and a 16% chance of a no hike at all. Unless there's something dramatic happens with the banking sector over in the next 24 hours, which I don't think there is. I think it's behind us. And Trump gets arrested or whatever drama comes about, which I don't think will really happen or do anything. I think that this is fairly baked in, and I think the market would be fairly stable. Economic front, we have existing home sales. They're looking at the value to be over 4 million compared to 4 million. Again, that number's not high, so maybe it'll be better than expected. European Central Bank, Christine Lagarde, I really like her a lot. She's a lot more transparent than squirrely Jerome Powell. Squirrely Jerome Powell. Lifted sentiment on the banking stocks on Monday, saying the central bank stands ready to respond as necessary to preserve stability in Eurozone. She doesn't mince words, and I like that about her a lot. A straight shooter. Imagine that in politics. Don't get me started. That's squirrely Powell. Shanghai closed higher, tracking a rebound in global equities. It looks like everybody's following along. Everybody's loving this Swiss lender, Credit Suisse, being rescued. Things are looking better. The sentiment is definitely getting better. And with that said, notice volatility is breaking down. Maybe a good opportunity to short this asset. This is VIXX. Let's see if there's any room still. Let's see if there's any room still in VXX. Ooh, yeah, it looks like it's going down. But it went from 50 to probably go down all the way to 42. We'll see. Maybe we'll short this thing as a bonus trade. Not sure if I needed to see a little rally on it. But nonetheless, that's where we're at. Meta rose 2% in pre-market after Morgan Stanley upgraded the stock. I find it really difficult to believe that Morgan Stanley upgraded Meta after all of these layoffs, but that may be the fact for the I have to read what the upgrade says, but I have to assume it's because they've been doing very aggressive layoffs, and they're doing some really good stuff in the AI field. Now, we got some fun stocks for earnings today. We got Nike, very big consumer stock. It'll be important. It'll be interesting to see how they're doing. China's now coming back up. I don't really have an opinion on Nike at this time. We got Tencent Music, Chinese company, and GameStop for all of those traders who a few years ago were trying to do the meme stock trades, which I did not approve of. But Nike, Tencent, and GameStop are showing earnings today. Now, as I mentioned, Utilities looks like it could go down on a downslide if interest rates go higher. But looking at individual sectors, which I really want to do right now, I want to show you how sentiment is looking. Sentiment is looking pretty good for consumer staples. It actually looks like it's coming up. Let me see. Let me just take a quick look at it. Yeah, see, sentiment looks like it's definitely coming up for consumer staples. I like consumer staples a lot right now. I really like them a lot right now. Oops. Oh, why does it do this to me? It looks like it's bouncing up nicely. I told you it would. I told you that it would. So I really like consumer staples right now. I think energy is way, way overdone. I think financials are way, way overdone. Just take a look at this chart. I mean, look at that. We're overdone, like really, really overdone. Basic materials are overdone, like way overdone. Maybe even hair, but it looks like it's done. And last but not least, real estate looks like it's overdone. The problem I see is the same thing as I'm seeing right here. You see this divergence in technology, and look at this. Look at the way look at how things are unfolding in technology. See that? It's still moving down. It's still moving down. It hasn't hit it. And if you look at the sectors, which are totally and completely out of whack, technology and communication services are still first in line. Now, the way I see it, these two are going to go down, especially with Fed raising rates, which may take utilities down too. Industrial, it looks great. Consumer staples look good. Healthcare looks good. Basic material looks good. Energy looks good. I'm expecting these to start coming back up at the expense of technology and communication. Utilities, question mark. Financials, question mark, because I don't know if there's going to be any more mishigas or craziness surrounding it. But for now, things look fairly stable. So be very, 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 very cautious. Now, today is Tuesday. And on Tuesday, I always give you the strongest sector, strongest stock, weakest sector, weakest stock. My advice to you right now is to stay with consumer staples. I'm not joking. Consumer staples are looking good. They were upgraded yesterday by, I don't remember who upgraded them, but somebody upgraded them, one of the major firms. I did a report on it. They were upgraded yesterday. The stocks are looking good. Some of these stocks are starting to come up again. And in an inflationary environment, there's no way in hell consumer staples are going to break down again right now, especially with interest rates going higher. So I like consumer staples a lot. And in terms of the sector that I don't like right now, I would be really, really, really cautious with technology. But I would actually prefer you guys stay with consumer discretionary, because technology and communication services and consumer discretionary are all going to go to the same place. And right now, consumer discretionary seems to be the weakest piece of the puzzle. So I would go long consumer staples and I would go short consumer discretionary. Now, in terms of the strongest stock on Wall Street, we got to be really, really cautious right now. Right now, let me just show you the stocks that I'm really liking, really, really liking. I like Marathon Petroleum a lot. I like Lamb Weston a lot. Petroleum, so healthcare and energy, I like those stocks. There's other stocks that I'm really liking right now, like GE. I really like GE right now, and I really like Quanta. So I just gave you several stocks. Be careful of Quanta. That's I think that may be a utility company. Let me just double check here. We got to be careful with that. Is that a natural gas or energy? Industrial. Yeah. That's a good one. All right, we're good. So we got Quanta. We got General Electric. Grainger looks great. And we got Marathon Petroleum. And we got Lamb Weston. I like those stocks a lot. Be cautious with the gambling stocks with the interest rate debacle, and they look like they're maybe losing their steam. So be a little cautious there. But I do like Lamb Weston. I do like Marathon Petroleum. I like Quanta, right here, Power, PWR, and I like General Electric. Boring stocks right now, not tech-heavy technology stocks. That's one of the reasons why I'm not bringing ANET into this, because that's a tech-heavy stock, and I'm very cautious with that. I want to be careful in light of the real estate, in light of what's happening right now with interest rates. Now, let's go the other way and tell you about stocks I'm not liking right now. Be very careful with banking stocks right now, because banks can rally. I would be very cautious with them right now. The stocks that I would right now go against would be something like Match.com, because they're near their lows, VFC near their lows, and Boston Properties that are near their lows. Also, Fidelity National Information Services, this stock is a goner. So if I was bearish on a stock, it would probably match and FIS. And I'm also bearish on utilities right now and volatility because I don't think this debacle is going to go anywhere or take us anywhere. Be very cautious. Another stock that I'm bearish on is CarMax. So you got CarMax, you got Fidelity National Information Services, and you got Match.com. I always over-deliver. I gave you 3 longs or 4 longs and 3 shorts today. Now, folks, before I let you go, I got something really important to say. Billions of dollars are flooding in and out of stocks every day. And when you see a fraction of that money hit a single stock, that injection of capital has the potential to send it exploding higher over the next 24 hours. Remember the show 24, where every episode was 24 hours? That's how these trades are. They're exactly 24 hours. No day trading margin, no day trading rules. You're trading overnight, you're getting in at the close, and you're getting out the next day at the close. It's one of Wall Street's best kept secrets. And that's why a good friend of mine, Chuck Hughes, and I are about to go live today, Tuesday, to pull back the curtain and reveal how the rest of us can target these stocks and take advantage of these opportunities. You want to do that? Follow the link below. Check out the live class. Today is the 21st of March, right? We only have a week and a half left in March, and it's happening at 1 p.m. Eastern Time. Now, if you want to subscribe to my Telegram channel where I give some free trades sometimes, the link is in the YouTube channel, in the Wealth Press YouTube channel below the video. Follow that link, check it out, like this channel, subscribe to the videos, and remember, Squirrely Powell is up next. Bye, guys. Have a great Tuesday. Have a great rest of the week. Send me emails, comments, feedback. support@marketgeeks.com is my email address. And if you're looking for more details, you can find it in the Wealth Press YouTube channel. Bye, guys. Have a great day ahead. Bye.